Have you ever looked at a stock chart and thought, what on earth am I looking at? Numbers going up, numbers going down, people on the news talking about the Dow Jones and the S&P 500 like everyone already knows what those mean. Don't worry. By the end of this video, you will. We're going to break down exactly how the stock market works, in plain English, starting from scratch. Whether you're thinking about investing for the first time, or you just want to understand what's going on when you open the financial news, this video is for you. We'll cover what the stock market actually is, how stocks work, how the market moves, how to read a basic stock chart, common mistakes beginners make, and how you can get started safely. Let's dive in. So what is the stock market? Think of it like a giant marketplace. Except instead of buying and selling groceries or furniture, people are buying and selling tiny pieces of companies. These tiny pieces are called shares, or stocks. When you buy a share of a company, say Apple or Nike, you become a part owner of that business. A very, very small part owner, but still an owner. Now, why would companies do this? Why would Apple let strangers own a piece of them? Because companies need money to grow. Instead of going to a bank and taking out a loan, they can sell shares to the public and raise millions, sometimes billions, of dollars almost instantly. This is called going public, or an IPO, an initial public offering. And why would you, as an investor, want to buy those shares? Because if the company does well, your shares become worth more than what you paid for them. That's how you make money. The stock market is just the system, the infrastructure, that makes all of this buying and selling possible in an organized, regulated way. In the US, the two main stock exchanges are the New York Stock Exchange, the NYSE, and the NASDAQ. When you hear people say, the market was up today, they're usually referring to broad indices that track how thousands of stocks are performing overall. Okay, so now you know what a stock is, but here's the question most people have next. Why does a stock price go up or down? The short answer, supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. But what makes people want to buy or sell in the first place? That's where it gets interesting. The main driver is how a company is performing and, just as importantly, how people expect it to perform in the future. If a company announces it made more profit than expected, what's called beating earnings, investors get excited, buy more shares, and the price goes up. If a company misses its targets, investors might panic, sell their shares, and the price drops. But here's the tricky part. Stock prices aren't just about what's happening right now. They reflect what investors believe will happen in the future. That's why you'll sometimes see a company's stock price fall even when it posts a good quarter, because investors were expecting an even better one. Lots of other things can also move prices. Interest rates set by the Federal Reserve, economic data like unemployment reports, geopolitical events, changes in the industry, even social media buzz or news headlines. The market is also moved by emotion, heavily. When investors are optimistic and prices are generally rising, we call that a bull market. When they're fearful and prices are falling, that's a bear market. You've probably heard those two terms a lot. All they mean is bull, optimism and rising prices, bear, pessimism and falling prices. Now, let's look at something that intimidates a lot of people, the stock chart. Honestly, once you know what you're looking at, it's pretty straightforward. The horizontal axis, the x-axis, is time. It could be showing minutes, days, months, or years, depending on how you set it. The vertical axis, the y-axis, is the stock price. So the line on the chart is simply, here's what this stock cost at each point in time. You've probably also seen charts that look like a bunch of colored rectangles. These are called candlestick charts, and they give you even more information. Each candle represents one time period, say, one day. The top of the rectangle shows where the price was at its highest that day. The bottom shows the lowest. The color tells you whether the price ended the day higher or lower than it started. Green typically means it went up. Red means it went down. You'll also hear people talk about trading volume, usually shown as bars at the bottom of the chart. Volume tells you how many shares were traded. High volume on a big price move? That tends to mean the move is meaningful. Low volume? Maybe less so. And then there are moving averages, lines that smooth out price data over a period like 50 days or 200 days. Investors use these to spot trends. Is the price generally moving up, down, or sideways? Don't worry about memorizing all of this right now. The main takeaway is that a stock chart tells a story. The story of how a company's value has moved over time, as seen through the eyes of the market. All right. Here's the segment that could actually save you a lot of money. Let's talk about the mistakes beginners make most often. Mistake number 1. Trying to time the market. This is the idea that you can figure out the perfect moment to buy and sell. Spoiler: even the most sophisticated professional investors and hedge funds consistently fail to do this reliably. Trying to predict short-term market moves is essentially gambling, not investing. Mistake number 2. Putting all your eggs in one basket. If you buy only one stock and it tanks, you lose everything you put in. Diversification, spreading your money across many different stocks, industries, and even asset types, is one of the most powerful risk management tools you have. Index funds, which we'll mention in a moment, make this very easy. Mistake number 3. Investing money you can't afford to lose. The stock market can drop 20, 30, even 50% during a bear market. It always recovers. Historically, it always has. But that recovery might take months or years. Never invest your emergency fund, your rent money, or money you'll need in the short term. Mistake number 4. Reacting to emotion. When the market drops, panic selling locks in your losses. When stocks are soaring, FOMO, the fear of missing out, can lead you to buy at the peak. The best investors have a plan and stick to it, regardless of how scary or exciting the headlines are. Mistake number 5. Ignoring fees. Investment fees and expense ratios might sound tiny, 0.5% here, 1% there, but compounded over decades, they can cost you tens of thousands of dollars. Always understand the costs of any investment product before you buy it. So how do you actually get started? Let's make this practical. Step 1. Build your knowledge base. You're already doing this. Great. Books like The Little Book of Common Sense Investing by John Bogle or A Random Walk Down Wall Street by Burton Malkiel are excellent starting points. Keep learning before you put real money in. Step 2. Open a brokerage account. This is the account you'll use to buy and sell stocks. Look for platforms with no trading commissions, a user-friendly interface, and educational resources. Many popular brokerages today have zero minimum balances to get started. Step 3. Consider starting with index funds. Rather than picking individual stocks, which is genuinely difficult and risky, index funds let you buy a tiny piece of hundreds or thousands of companies at once. An S&P 500 index fund, for example, tracks the 500 largest U.S. companies. Historically, this has produced solid returns over the long term, with far less risk than betting on individual stocks. Step 4. Invest consistently. A strategy called dollar cost averaging means you invest a fixed amount regularly, say every month, regardless of whether the market is up or down. This removes emotion from the equation and takes advantage of market dips automatically. Step 5. Think long-term. The stock market has always recovered from crashes, corrections, and recessions. The investors who build real wealth are the ones who stay in the game, stay patient, and let compound growth do its work over years and decades. The stock market isn't a casino, though it can feel like one in the short term. Approached with patience, diversification, and a long-term mindset, it's one of the most powerful wealth-building tools available to ordinary people. You now know what the stock market is, how stocks are priced, how to read a chart, what mistakes to avoid, and how to take your first step. That puts you ahead of a huge percentage of people. If this video helped you, subscribe for more and drop a comment. I'd love to hear where you are on your investing journey. And remember, the best time to start learning about investing was yesterday. The second best time is right now. Disclaimer. This is for educational purposes only. Nothing in this content constitutes financial advice. Always do your own research or consult a qualified financial professional before making investment decisions. Please subscribe to the channel.